Good day, Market Chameleons, and everyone joining for the first time. Thanks for coming by and checking out the Market Chameleon live webinar series. Before we get started, let's take a look at the shared disclaimer. Please be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker dealer. If you're searching for investment advice, please reach out to a licensed professional. This webinar, as all our webinars and shows, are for informational purposes only for Market Chameleon tools and products. With that, one last look at the disclaimer, and let's welcome Dimitri Programarnik to the stage. He's going to be talking about screening for at-the-money straddles. How you doing, D?
Good morning. Well, how are you?
Great. There's the Market Chameleon landing page. Looks great today.
Good morning, everyone. Let me navigate to the page, and this is based on a question that we got on the email. And the question was, well, can I see historically where the implied earnings moves or the earnings expectations underpriced the actual move? So the actual move was greater than the anticipated move, and how often did that happen? So first, let's navigate to a screener that will help us, look at for those types of insights. And I'm going to go to earnings up top, and what we're going to do is look at the earnings option strategy screener. So the expectations that we're looking for, where the markets either underpriced or overpriced the actual moves. Well, those expectations we could observe in the options markets, right? Because that's what the options markets do. They're forward-looking volatility instruments, and how are those straddles, right? So when we look at the option strategies and we look for the movement of the stock in either direction, well, we could reference the straddle, because the straddle is a non-directional strategy. You're buying a call, you're buying a put on the same strike that's at the money. So from there, for you to break even, the stock at expiration has to move by the percentage of the cost of that straddle. So whatever you bought, if the stock's $100 and you bought the put for $5, you bought the call for $5, well, you spent $10. So if you're spending $10 with the stock at 100, well, it has to move 10% in either direction for you to break even. Because if it's the stock is down $10, well, the put will be worth 10. The call option will be worth 0. So that's your break even. On the upside, the stock goes to 110. Well, the call is worth $10. The put is worthless at expiration. That's your break even. So similarly, we have to take a look at the straddle price right before earnings and see, well, how did that straddle do the next day? And this will tell us if that expectation priced in that straddle, was it too high or too low, right? So if the straddle increases in price, well, it was underpriced, right? Because the next day the straddle was higher, so the stock moved, straddle gained in value. Well, then it was undervalued. Then it underpriced the move. If the straddle loses value, the stock moves and loses value. Well, now you got premium taken out, so it overpriced that move. The straddle lost value. So we could look at the straddle end of day before, right before earnings, and end of day afterwards, to see what was the straddle performance. And historically, if it was underpriced, then you would see that it was profitable over a different set of earnings. And we could see the frequency. How often was it profitable? How often was it unprofitable? So that's what we're going to do. So now we're on this earnings option strategy screener. And this looks at different strategies around earnings. So this is anchored or pegged to an earnings event. And then what we do is look at the options around that event to see how those options perform, right? So we're going to normalize it to some strategy. And what we're looking for in particular is the straddle. So we have, lots of different strategies in here, for all these stocks looking historically. But what we're going to do is first take this strategy. You see all these different strategies, and we're going to filter them down to at the money straddles. So we're going to go strategy type, and then we're going to take a look at a long at the money straddle. Okay, so click on that, and this will now filter. You could see long at the money straddles. See, these are the different symbols here. These are long at the money straddles, but we have different date ranges that we could test, right? Because we could look at a straddle 2 days before earnings or 3 days before earnings, and we could look at that straddle, even how it performed right before earnings or after earnings, or even wait more a week after earnings. But let's take a look at how it was priced, right before earnings. So the assumption is there that it at that point, it includes all the different opinions of traders and reaches this value right before earnings. And how did the straddle look like the day after reported earnings? It has a full day of trading. You got everything coming in. How did that same straddle end up at the end of the day, the next day? And was it profitable or unprofitable? So let's change the date ranges. The date ranges will be the opening reference price will be the day before earnings and the day, and the closing would be day of the earnings and the day. Okay, so this is what it is. It's like we're looking end of day right before the report of earnings. So it could have been after the close. It could be before the market opens the next morning. But, as long as it's end of day right before the earnings announcement, and then we look at the end of day after the announcement. Okay, so as you could see here, now we narrowed these down at the money straddle, date ranges. And now we have all these symbols in here. So let's look at the stats. So this is looking at the last 12 earnings. Okay, if you click on it, it'll show you the data like this. So these are the dates, the earnings. This is where the call and put was marked. This is and this before. This is where it was after. This is the put before. This is where it's after. So we could then, add them up. The cost of this plus this the day before, then the cost of this and this the day after. Did it gain in value and by how much? Okay, and this is what the stock did. So these are looking at last 12 earnings, which keep in mind, 12 earnings, we're going back, 3 years of data, because earnings, you have, only 4, quarterly earnings 4 times a year. So we're going back already like 3 years. So we're trying to keep it, initially to the data that we could say is the most recent. If you want to go back further, you could go to the options chain and do the same thing, go back further. So let's come back to this. I'm going to close and go back to the screener. So here you can see we have the last 12 quarters. And what are the stats? Right? So if we're looking at it from a long perspective, here's that money straddle. How frequently was it profitable in the last 12 quarters? This will let us kind of know, how well did the market's pricing expectations. All right. So here, for example, in AAL, 33% of the time out of these 12 were the straddle increased in price, right? From the long perspective, it increased in price. That would have been a winner. So 1/3 winner, 2/3 it was a loser. Okay, that's the historical perspective. You can see here in Apple, 25%. This ABBV, 58%. So now we get like a sense of, for each stock, a historical perspective, the frequency that the straddle increased in value or decreased in value day after earnings. So the next thing is, well, when we look at a straddle, the payoffs are different. It could increase by very little, decrease by a lot. It could increase by a lot, decrease by a little. So what were those average returns, right? So if you bought $1,000 worth of straddles every time, so every time, whatever the prices were, you bought $1,000 worth of options, right? Well, sometimes, when they were down, you could have lost $500, you could have lost $600, or you could have lost $1. And the times they were up, you could have made $1, or you could have made $1,000 or $5,000 or $200. So let's figure that out, because you could have a lot of winning straddles, but if the wins are very small and the losses are very big, well, on average, you still lost, right? At the end of the day, on net, you lost, even though you had more wins, right? So if I do something 10 times and I invest $1 and 9 times, you make $1, it's worth $1,000. But at the time you lost, it went from 1,000 to 0. Well, that's still a net loss, right? So what was our average returns if we averaged them all out? So here it is. So these are the average returns. So you can see, we have negatives here. So you can see here we have a positive here, even though we had 42% of the frequency of the wins, but some of those wins in those 42% were big enough to offset lots of the losses. Okay, so this is saying that the stock could be very volatile, and some of these big moves potentially historically offset even the losses, even though there were more frequent losses. So that's the average return. Okay, over here, the median return. Well, this tells us if we took these 12 observations, and we said, okay, sort them from highest to lowest, and then give me, and cut them in half. Half of the observations were above this return, half were below. That's negative 31%. So you could see that there's definitely a skew to the downside, right? So it wasn't like, it's half of the returns, lost more than 31%. And, the other half, had losses in there too, because this is negative 31%. So that's the median return. And then we have a range. So the range is like, well, what is the best return in the last 12 quarters? And what's the worst, right? So this gives us like the historical high-low range. So this shows us that the best return in this particular stock, AAL, was 79%. Okay, so it's like a straddle. If you bought $1,000 worth of options, the call and the put, well, the next day, let's say it went up 80%, that would have been worth $1,800, right? The worst return was 64%. Okay, so $1,000 would have lost $640. So now you kind of get a range of the best and worst in our data set. Okay, and this is the standard deviation of those returns. So what is important here is that if we have these returns, sometimes up 10%, sometimes down 15%, sometimes. So the more variability, right, the more risky it is, because it's not exactly like, hey, 12 times it's either you win $1 or lose $1. Then the standard deviation will be small. But if the returns are all over the place, the standard deviation of those returns will be high. It's telling you how risky historically these returns have been. Very unpredictable. That you could be anywhere, from 100% to 500% return, and everything in between there. So that's the standard deviation of these returns. The higher these are, the more risky it is. It's harder, to price these options, or anticipate the earnings. And then, we have this sharp, which will take the average return of the straddle divided by its standard deviations of returns. So, obviously a negative one is because the returns were negative. Positive one was what the returns were positive. But even when the returns are positive, if we look at the standard deviations of these returns, you'll get a low number, low sharp, meaning that, lots of risk. Even though it's a positive, you got like tons of risk in there. That as a trader you should be aware of, because when you're looking at something and for your potential returns, you have to weigh them against your potential risk, right? It's a ratio of expected returns versus the expected risks that you're taking. The more risk you're taking, the more expected return you should factor in. Okay, so that's where these numbers come in to quickly give us a historical perspective. If we click in it, let's say for Apple, we click on these 12 observations, right? So we could now see them over here. So we see, where they gained, which dates over here. We could see where they lost. You can see here it's been on those straddles have been on the lose. They've been overpricing the moves. These were the percentage returns, negative percentage returns, and this is what the stock did. So you could see from previous day to next day, these were the percentage move. Here's a 3.5% move. So, there are a couple here where, Apple moved almost 6%. So this straddle gained. Apple moved here 4.7%. So this straddle gained. This Apple moved down 5%. But remember, up or down, we're looking at the straddle. So 5% move, this straddle gain. And this gives us our historical perspective of the straddle pricing of the expected earnings, prior to announcement. All right, well, I'm going to stop there and throw it back to you.
That was a great webinar, D. Thanks for bringing it to the Chameleon community. We'll see you tomorrow, my friend.
Thanks, everyone, for joining. Stay safe out there and have a great trading day.
Have a great day, D. Bye. Hey, everyone. Thanks for joining. Remember to like and follow us on all the social platforms. If you're on YouTube, thumbs up, always appreciated. Everyone have a great, safe trading day. You get rid of that squirrel, Swami. I had flying squirrels in my house one time, and they said when they get them, they're going to have to take them at least 20 miles away across the river. I don't know if you got a river close by, but good luck with that, or just, I guess, take them out back and make stew. Everyone have a great, safe day. I will talk to you later. Bye.